The following is provided by Boyar's Intrinsic Value Research and is for general informational purposes only and should not be construed as investment advice. Any opinions expressed herein represent current opinions of Boyar Research only. Boyar Research assumes no obligation to update or revise such information. Investing in securities involves risk, including the possible loss of principal. Past performance does not guarantee future results. Employees of Boyar Research or clients of an affiliate may own shares in any company discussed.
You're proposing increasing your stake in the company. It's a long, involved saga, dating back to the financial crisis. Can you just give us a quick overview of, how we got here and what your proposal is?
The background here is November 2008. We're in the middle of a financial crisis. The markets are blowing up. And a company called General Growth Properties, stock declines over a several-month period from $63 a share to 34 cents, 99.5% or so decline. And this is the second largest shopping mall company in the country. They own, so to speak, Class A malls. These are, the best, most beautiful, modern malls. And interestingly, the net operating income, which is kind of a financial measure of performance for a real estate company, actually grew year on year between 2008 and 2009. And the occupancy percentage occupied of the mall increased over the year, but the stock price is down 99.5%. Well, that's sort of an interesting, contradiction. And the reason why the stock price declined so much is that the company was on the brink of bankruptcy. And they were on the brink of bankruptcy because they couldn't pay their debts when they were coming due. And they had financed themselves principally in the CMBS market. These are mortgage-backed securities. And they had relatively short-term debt. They were very aggressive in the way they financed themselves, and that debt was coming due within 18 months. And and something like 2/3 of their $27 billion worth of debt was coming due within 2 years. And the world knew they couldn't refinance it because that market had shut down. And so people said they're going to go bankrupt. Every other company went bankrupt. The shareholders lost everything, and as a result, the stock traded where it did. What we did was we studied the bankruptcy code just to make sure that, I said, well, why can't there be a recovery and a bankruptcy for shareholders? The assets are worth more than liabilities. Isn't the hierarchy of claims in bankruptcy supposed to work that way? Even though it hadn't in the public markets before, I thought this was a perfect test case. And with advice from some good lawyers who kind of agreed with our understanding of the law, we bought 25% of the company in the open market. Started at 34 cents a share, probably paid up to $1. Average cost was something like 60 cents. And we paid $60 million for 25%, so $240 million for the equity of the company. It had $27 billion of debt, so 99% debt, 1% equity. That's the kind of leverage, if it works, it works. And then I lobbied to get on the board, eventually got on the board of directors after the company filed for bankruptcy. And then I led a restructuring for the benefit of not just the creditors, but the shareholders, which just never happens because the distressed funds buy the debt that was trading at pennies on the dollar, 30 cents for the unsecured debt, 10 cents for the converts, and there was plenty of value to go around. And part of the way we unearthed value is one of the things that took General Growth down was they had this master plan community business where they relied on cash from lot sales in part to cover their debt service. And when the financial crisis happened, people stopped buying. Home builders stopped buying lots because they didn't have any money. People stopped buying homes. So the result of all of the above was I said, hey, if we're going to make this company emerge, it will trade a lot better if we get rid of all the ancillary stuff. And we took all the ancillary stuff, we stuffed it in a new corporation. General Growth had purchased the Howard Hughes Corporation from Rouse Company, or they had purchased the Rouse Company, which in turn owned Howard Hughes, which in turn owned downtown Summerlin in Las Vegas. Howard Hughes was a noted real estate investor owner. And this was sort of a sideshow to our General Growth investment. General Growth stock, if you had held it from the time we bought to the time, it's sort of the peak when we spun off Howard Hughes, it was like almost 100-fold return. And then Howard Hughes became sort of this work in progress. And we hired a very entrepreneurial management team, and we owned a jumble of assets. It took us years to figure out the right strategy. We bought out the Hughes heirs that owned half of the Summerlin asset. We bought out Morgan Stanley Real Estate Fund that owned half of the Woodlands. We bought out Blackstone, Brookfield, and Fairhome that were kind of initial investors with us in the company. But again, it was a sideshow. We did this transaction, and we made a ton on General Growth. But in order to do that, we had to sort of spin off the stuff. And, in the early days, people got excited about Howard Hughes stock. Stock went from 47 to like $150 a share. There was, rumors, or the story on the street was we're going to turn it into, Pershing Square's next, going to be the next Berkshire Hathaway. And then when that didn't happen, the stock went back right back down. And it's always seemed to trade based on the worst performing asset we own. So what's unusual about Howard Hughes is it owns shopping malls, or not really shopping malls. It owns retail, open air retail. It owns office buildings. It owns apartments. It owns storage assets, but most significantly, it owns land. About 2/3, 70% of the value of the company, at least the way that calculated by the management team, is land, commercial land and residential land. And this land is not just scattered around the country. It's in what we call master plan communities. I call them at this point, the big ones, master plan cities, because they have high rise, office buildings and they look like real cities. And the business of the company is sort of being the benign manager of these small cities and building office buildings when you need tenants need space, and building apartments when people move in, selling lots to home builders. And it's a very interesting business. But it's like a 50-year story in a public market that wants to know how you're going to do next quarter. And actually, the company's announcing earnings tonight. I think the earnings call is tomorrow. So we'll see what the earnings are. But the earnings for the quarter never really matter for this company. For the year, they don't really matter. There isn't like an earnings per share metric that you can really rely on and think about the value of the business. So the company's really struggled to find a long-term shareholder constituency. The stock has always traded at a very deep discount to management's estimate of net asset value, 40% or so discount. And it's sort of been a bit of an outlier in our portfolio because we own, for the most part, mega cap and large cap companies. We're a minority shareholder, an influential minority. And we sort of have this Howard Hughes thing. And for years, we've tried to figure out what to do with it. And finally, we said, look, no one's going to care. We spun off the South Street Seaport assets. We did the same thing to Howard Hughes that we did to General Growth. We're like, okay, the overhang is we own this loss-making part of New York City, downtown. We own a baseball team, minor league team. We own a baseball stadium. We own some air rights. No one's giving us value for this stuff. Let's spin it off in a new company. But as importantly, let's recruit a management team that's well served to maximize the value of these assets. And we hired a guy named Anton Nicodemus, really from the kind of Las Vegas casino world, entertainment world, gaming world. And we think he's the right guy to fix our that little company. But our assumption is once we spun that off, magically this would be the last thing we need to do to get people to focus on the Howard Hughes story. Howard Hughes stock went down after we spun it off. And why? Because, this interest rates have gone up, mortgage rates have gone up. People are concerned about what's going on, home builders in a higher interest rate environment. There is some concern that, some combination of tariffs and the volatility of the Trump administration will lead to an economic, downturn, and people worry about lot sales in an environment like that. The company also has its biggest income producing asset is office space or office assets. And the work from home movement, hopefully it's starting to head, you can bearish on work from home now, but still office assets are not the favored asset class. And the stock is kind of languishing in the low 60s. And we said, look, maybe we should just take it private and own it for that very long term. And that's what started this journey. That was August 6th when we filed our 13D. And we hired Jefferies. And we ran a process to raise enough capital to take the business private. And, ultimately, after a several-month process, we did not have anyone come forward to say, okay, I want to lead this thing. We had some people expressed interest in, possibly participating depending on the terms. But we struggled to raise the money we needed to do this transaction, and we went to Plan B. And Plan B was, okay, well, maybe we leave the company public and we buy a bigger stake. It's not going to make it as a pure real estate company. Why don't we use this? I've always had this ambition to build a rival, if you will, to Berkshire Hathaway. Let's create our own modern day version of Berkshire Hathaway, and we'll make Howard Hughes the real estate assets, the base, and we'll build off there. And our transaction that we proposed, which is a simpler version of the first one, is simply we'll just buy more stock in the company. We'll buy another 10 million shares. That will take us from 18.9 to 29.9. And that will give us 48% of the shares. I'll take an executive role along with Ryan Israel and Ben Hakim, kind of three of the key principals, three members of the Pershing Square investment team. And we'll use the cash that we put into the company to start acquiring non-real estate related operating companies and businesses that meet our criteria. And, that's the basic idea.
Are you planning on buying minority stakes the way Buffett does, where he'll buy X amount of Coke and just sit there? Or do you want to buy controlling interests or both?
The nature of a U.S. C corporation operating company, in order to maintain that status and not be an investment company, you have the substantial majority of your assets have to be in controlling stakes or 100% stakes in public and private companies. So that is our business plan. On the margin, could we own a minority stake in something? It's possible, but it would more likely be a minority stake on a path to control. So Pershing Square today has one strategy, which is we have a number of funds. They all invest in the same companies, which is we buy minority stakes in a Google, let's say, or an Uber, and we're an important influential shareholder. We're not a controlling shareholder, and we own those stakes for the long term. But liquid public stakes companies. The strategy of Howard Hughes, if this transaction goes forward, is for us to buy smaller, principally private companies or controlling interests in small cap companies. Certainly, that's how we'll start.
So you're going to buy controlling interests in kind of private businesses. One of the problems that HHH has now is people don't know how to value it. It's complicated. They have to do a ton of due diligence. Why is this time going to be different if you own a bunch of stakes in pretty much privately held businesses?
Sure. So one, we'll have very good disclosure, and I think we'll do a good job explaining what we're up to. Two, I think our track record is public, but we've had an excellent track record in doing so. And most importantly, we think there's a large base of investors who want to invest alongside us and will trust our judgment. They'll trust but verify. And they'll understand the strategy as we explain it to them. And it won't be the problem with a pure play master plan community company. It has, enormous exposure economically to interest rates, home building, and also it's not an investment grade company that has continuous access to low cost capital. So I think Howard Hughes is an amazing business, but it should be part of a portfolio of businesses. And again, there's precedent for what we want to do here. The two models that I said a modern day Berkshire Hathaway, but we could also throw Leucadia National Corp into the mix. I'm a big Joe Steinberg fan and Ian Cumming fan of blessed memory. Joe is still with us, active. He's now chairs Jefferies. They do a good job explaining their business to shareholders, or they did when they ran it as Leucadia National, and the stock did very well over a very long period of time. The key is compounding the intrinsic value of the business, and the stock will trade plus or minus to that intrinsic value over time. And as the manager of that business, my job as chief capital allocator would be to make sure that we take advantage of opportunities that present themselves. But I do think there's a lot more hope for a diversified holding company that we just invest, where a management team has come in and invested $900 million of their own capital and put a stake in the ground that we're going to build this into something interesting, and have a good track record for doing so. We have an amazing team with, whose background is actually doing precisely this, private equity. If you look at the Pershing Square team, it's Blackstone University, KKR University, Hellman & Friedman, Warburg Pincus, Apollo. It's a team that was trained in private equity, and we haven't been able to use those resources, and now we will have a platform to do that.
So you're going to diversify it away from the master plan community business. Let's say 3, 5, 10 years from now, what percent of the value of the company would you envision being MPCs versus whatever it is you buy?
Well, I expect the MPC business to continue to compound at a nice rate over time, a double-digit rate over time. And I think in our plan is to continue, the team there is excellent. David O'Reilly, Carlos, run that operation, and as importantly, the presidents of our various MPCs have done a fabulous job as kind of chief developers. We love that business, and that business was going to continue. So we're not like talking about like liquidating that business and repurposing the capital elsewhere. So that business is going to grow. And then we have 900 million of capital that we're going to use as equity to invest in businesses that are probably more likely to grow at a faster rate than a real estate MPC business can grow at. And depending on how quickly we deploy that capital and what kind of businesses, that will affect the mix. But 10 years from now, majority of the assets will probably be other than the current MPC business. That's not to say we won't do other really interesting real estate transactions if they come around. But I do think the focus here is going to be on operating companies that generate recurring and growing cash flow streams that, meet the Pershing Square standards. And we put out our investment principles pretty publicly that kind of meet our investment principles.
And you're going to be the CEO. Do you imagine yourself more Buffett or Greg Abel in terms of getting, involved in the individual businesses?
So the way we've approached investing in companies today is we don't want to be in a position to have to run the day-to-day operations of any company in which we invest. So what we want to do is make sure that the right person's running it. So, Chipotle Steve Ells needed help. We bought 10% of the stock. We joined that board. We recruited, Brian Nickel to run that business. We brought Hunter Harrison to Canadian Pacific. We brought Stephanie Kasemi, to Air Products. And I would say more recently, we found companies that already had excellent management. We're big Dara fans at Uber, right? We really like the management teams of all the companies that we are shareholders of today. So, the key for us is finding someone who can run the business. Our job is to kind of oversee how's management doing, make sure they have the right incentives, help make sure they make the right capital allocation decisions. But we view our job as more chief capital allocator. Maybe we focus on designing compensation incentives and then, making the hard decision sometimes to replace a leader. But we don't run the businesses day. So Greg Abel, I think of as more of an operator. Now you're going to have more of an operator in charge of Berkshire. And I think there's a lot of value that can be created at Berkshire with better operations. I mean, Burlington Northern, for example, is the biggest railroad, but it's probably the least efficiently operated of all the railroads. And so, I think Buffett is sort of reluctant to in any way get involved in the, fixing companies. And he has CEOs that he probably should have replaced years ago. I think the next generation of leadership will be a little more disciplined about making sure the right people run the companies. But we view our role as capital allocation, certainly beginning of life of this company, identifying transactions, executing on them, after we do proper due diligence, making sure the right person's running them, giving them right incentives and letting them do their thing.
Just going back in terms of the discount that we were talking about and, conglomerates traded at a discount. I mean, you have a European listed fund that's done quite well over time, but it's been trades at a perpetual discount. I mean, if you really wanted to buy Howard Hughes cheaply now, you just buy part of your fund there and get it at a 30% discount. You have a huge following on Twitter or X, whatever you want to call it. How come you haven't been able to close that gap, and why is it going to be different this time?
Imagine theoretically, there's a closed-end fund that trades in Europe that's managed by a U.S. investor that invests in U.S. securities. And therefore, the principal market for that, you would think, absent it being offshore, would be U.S. investors. But for regulatory reasons, that entity can't be in the United States. It has to be offshore. So that's one problem. But the bigger issue is that the tax consequences for a U.S. investor investing in an offshore closed-end fund, in fact, one that has very low tax basis in its assets, are very negative. So, for example, if an investor invests in an offshore closed-end fund and its basis in company ABC is $10 a share, and the stock today is 100, and they buy today, and that stock ends up being sold by the manager of that closed-end fund, the new investor gets $90 of gain, even though they didn't experience any of the appreciation in the stock. So imagine there's a closed-end fund with a basis in the underlying assets. It's a fraction of where the stock trades. On that issue alone, it makes it impossible for a U.S. investor to own it. And then imagine the U.S. regulator says, I don't like American investors, particularly retail, to invest in offshore hedge funds. And so the regulator makes it very difficult for brokerage firms to allow their clients to buy it. And then imagine that entity does extremely well over the last 7 years and compounds at, mid 20s. And it grows to become the second largest closed-end fund in the world. So the supply has increased massively, but the principal source of demand has been eliminated due to tax and regulatory reasons. You would expect a discount to emerge and a wide one over that period. Now, compare that to a US C Corp, where anyone can own it for 74. You can buy one share, or you can buy a fractional share through Robinhood or one of these other sites, but one share for $74. And anyone can own it, really without restriction globally. And I think the universe of investors that would like to find another Berkshire is much broader. Ryan and I gave a talk at Berkshire Hathaway meeting last year. We're going to go back this year. And we opened it up. It was sponsored by UBS. We had 300 seats in the room. And the seats disappeared, like, embarrassingly to say, like a Taylor Swift concert. We had to have security keeping people from banging down the door. So, Pershing Square has an unusual following among investors, among retail investors, among institutional investors. And I think that group would love the opportunity to invest alongside us, not in a hedge fund where they're restricted to invest or it's illiquid. You have to lock your money up, but in a public vehicle where we offer a bargain arrangement from a compensation perspective. For the first time we don't charge a 20 or 16% incentive fee. And, we did a Spaces, which I'm sure you listened to, about this transaction. And we had, 2,500 or so retail, principally retail. There are probably some institutions, hopefully many, asking questions and making comments. And it was like a Berkshire meeting in a way. And I think that is a likely base of shareholder demand for this entity. And I think it's the base of that shareholder group. Retail is the largest base of demand for any company. Ultimately, vastly overwhelms, the very niche market of people who want to invest in a pure play master plan community company, that has a very small market cap and public float.
Have you ever done an analysis of, let's say, your Twitter followers or whatnot to see, can they really buy a meaningful amount of shares? I don't know what kind of information Twitter would give you.
I think it's something we need to work on. I would love to know more about my followers.
Clearly 1.6 million, some of them will be able to buy lots, others, maybe it's a share.
I think all of them can own it. I mean, they're only the public float here. Here's one fun way to look at it. The public float of Howard Hughes, we own 18.9 million out of, call it 50 million shares, or 31 million shares. So if each of my followers buys 20 shares, that accounts for the entire public float. So
last year, Pershing Square Capital Management, which is different than Pershing Square Holdings, you announced a sale for about 10% for a little over $1 billion. At the time, you announced the proceeds were to be used for, anchor investments, fund launches. Did you have HHH in the back of your mind when you sold these shares?
We thought of it after that transaction closed.
Just curious, what you don't seem like someone who'd have trouble raising money. I know you had difficulties with the closed-end fund, but that's for other reasons. Why would you need to sell shares in your company in order to have anchor investors? It seems like you would have no problem attracting people on their own.
Sure. So the reason why I did that, there were several reasons why I sold an interest in the management company. The principal one was, in the world where Bill gets hit by a pie truck, number one, I want Pershing Square to survive. And two, I didn't want my wife to own an interest in a private hedge fund as her principal asset. So I thought the biggest proof point that Pershing Square can survive Bill getting hit by a pie truck, if I can convince a group of sophisticated investors that there was enormous depth to the Pershing Square organization, that, Ryan is a superb CIO, that the business functions very differently today than it did, 10, 15, 20 years ago. So I achieved that objective by bringing in a, group of sophisticated investors, 20 odd family offices, 6 or so institutions. And from the moment that it came in, I've been running it as if it were a public company in terms of the nature of the disclosure. We were operating with an independent board of directors. Again, I'm hoping to live a very long time. But it's that kind of a plan. And then in terms of, we didn't really want to take money off the table. Right? We weren't looking at cash out. So we kept the money in treasury.
I run a money management firm and a research firm, and I speak to a lot of managers, and we've written favorably about Howard Hughes for too long, in terms of
You too, huh?
hasn't been one of our better calls, but
I call it Howard Hughes is like Waiting for Godot. If you saw the play,
in terms of two complaints I'm hearing, and I'm not part of any group or any of that kind of stuff for my compliance people, but it's price and the management fee. Those are the two, and actually a third that emerged. I wrote a letter. I thought I did it in a respectful way. Well, I guess I did, because you appeared on the podcast, voicing my displeasure on the deal. But so there's two things. It's the price, it's the management fee, and now lack of a shareholder vote, which people are kind of really upset with. If you were a shareholder in a company and had a dominant percentage, I mean, if you were in my shoes, like, how would you view them?
the good news is the same three issues you've identified, we've heard.
These are not new to you.
The reason why I was late for your podcast is I was writing a letter to the special committee on exactly those three issues. So I should just post on your show. Let's talk about price. So number one, we're not taking the company private at $90 a share, to be really clear. We're buying an additional interest in the company at $90 a share. And what people say is, oh, well, management's estimate of net asset value is 118. Why should the company sell stock at 90? Right? That's the question. And the answer is really several-fold. So number one, let's talk about the management's estimate of NAV. So I think it's useful to track management's estimate of NAV for Howard Hughes because it's a measure. It's kind of a yardstick of measurement. I don't think it's not ever been a yardstick of measurement of where the stock's going to trade. It's been a yardstick of measurement from where the stock has traded at a very significant discount. And the discount's been about 40%. Management puts out an estimate, the stock's been around, 38 to 40% discount to that measure. And I think what people are doing is they're conflating that measure of NAV for Howard Hughes with the same measure of NAV they use for all the other public real estate companies, which are basically real estate investment trusts. And in the case of the real estate investment trust, NAV is a very good measure of intrinsic value. Why? Well, at the evidence. If you look at Green Street is probably certainly the most respected analyst in the real estate space. And if you look at their estimates of NAV for whether office or retail or apartments, and you look at it over time, the Green Street estimate versus the stock prices, and the estimates, has kind of moved around over time. And there was sort of a band. Sometimes the REITs trade above, sometimes the REITs trade below. In fact, we did a chart in our presentation that showed how REITs have traded relative to Green Street NAVs over time. And it looks like it's almost like the value is tethered to NAV. And the reason why that happens in the REIT space and with apartments and office in apartments is because if the discount gets wide enough, there's things you can do about it. So Blackstone has been over years ago, but occasionally even now, has been a big buyer of REITs when they trade at deep discounts to NAV, right? There's a value unlocking thing that can happen. Why? Because if Blackstone can buy a REIT, they could liquidate it. They could sell off apartment complex by apartment complex and get back NAV minus some transaction costs, which are relatively small, unless there's a lot of debt, kind of at a bad price. Or an activist will come in, right? Or an unsolicited buyer can come in and if the discount is wide enough. There's also no underlying tax in a REIT. So when you liquidate, there's no corporate tax that needs to be paid. So let's compare with Howard Hughes. So as you mentioned, Howard Hughes is not a simple entity, right? It owns every property type. And it's a C Corp, which means, and by the way, we have very low basis in the vast majority of our assets relative to what those assets are worth if we were to sell them on the open market, which means that the tax friction here alone is a huge number.
One quick thing, you're talking about tax basis. On your Howard Hughes investment piece of the general growth property spin out, is your basis around 43 or is it significantly below that because that's material?
Yeah, I don't know, Art, what the precise tax basis the underlying assets is, but real estate assets you depreciate over time.
Yeah, but I meant your cost basis.
Oh, our cost basis, I don't know precisely what our cost basis is, but we did buy, stock. Most of the stock we purchased, we bought in a rights offering at 47, 25 per share. We sold some stock over time. We bought some stock over time. But I would say today's basis, ignoring time value of money, is not materially lower than the current share price.
So you're not getting general growth at 33 cents attributed to that. Okay. That was.
No. I'm not talking about the tax basis of the shareholders in this case. I'm talking
Yeah,
about
of
the
course,
tax basis of the company and the underlying asset. So
Yes.
if you were to adjust the management's 118 for NAV, okay, you have to take off taxes. That would take the NAV number down materially. But more important than that, as I mentioned earlier, 2/3 of the assets here are residential land, kind of developed and undeveloped lots, and mostly undeveloped, and commercial land. And there is no market. You can't buy Howard Hughes and then turn around and sell the vacant land in Summerlin for anything close to where we sold lots last quarter. There are buyers in a carefully managed auction every few months by Howard Hughes for lots to home builders. If you said to the home builders, we're going to put 2,000 acres on the market, okay, instead of 50, okay, there's no bid because home builders don't want to hold thousands of acres on balance sheet. And the discount rates, I don't know that there actually is a buyer for bulk purchases of this kind of land. And if there is one, it's a fraction of what the company's using as the net asset value. And so you can't follow the same path you can in the REIT world. So I think it's a reasonable yardstick to kind of judge over time, but it's not like intrinsic value that can be realized 90 days after someone buys the company. And the company tried to sell itself in 2019, and effectively the company tried to sell itself by virtue of the process we ran. And as you say, we're pretty good at raising money, and we had a lot of people interested, but everyone wanted to know how they could get liquidity in 5 or 7 or 10 years. And there isn't a path to liquidity for this company. It's like you have to find someone who's prepared to own it for 50 years. And that really deterred the vast majority of investors.
You approach sovereign wealth funds. It seems like a perfect.
Trust me, 240 people contacted. Assume every sovereign wealth fund, every mega family office, every REIT, real estate, private equity, Blackstone, Brookfield, Starwood, make your list of who you would logically talk to. We talked to them, or Jeffries did. And very few investors today want illiquid. I mean, today everyone's stuck with all their private equity, illiquid investments. So on NAV, I don't think it's a reasonable measure for where someone buys a minority stake in the company as they become the management of the company. In fact, I've never seen a new CEO of a company come in and say, I'm going to buy stock at a 46% premium to the last trade, let alone 900 million of that stock compared to where the stock was trading before we announced that we were considering a transaction. So I think we're paying a massive price relative to where any third party would buy stock. The easy way to solve this problem, if people think we're getting a special deal buying stock at 90, okay, is we'll do a rights offering. We'll backstop the rights offering. We'll charge nothing to backstop the rights offering. We'll give everyone the right to buy their pro rata share of stock in the company, and we'll just buy what's left. We'll buy our pro rata, obviously, and we'll buy the balance of shares that are not taken up by other shareholders. And that's how you solve that problem. So a rights offering, I think, solves, because we need to put capital into the company to change the strategy. So then the question is, what price? I would argue the price should be market. Market was 61. Okay, now market's 75. But you know what? We're going to set a high bar and we're going to build from that bar. So so we'll pay 90. But I think we're doing, frankly, the company. Now, when a company sells stock, it's about what do you get for what you give? Okay. The company's getting 900 million of cash and is giving away, 10 million shares of stock in exchange. What really matters is what's going to happen to the company the day after. Will the stock trade better? Will people assign a higher value to the company? And will we deploy the capital in a way that will create more value over time? And I think the answer to those questions are yes in all cases. And here's a simple way to think about it, right? Let's get to the management fee, and then I'll look at both in conjunction. Let's talk about the management fee. Okay, so I guess first I would say I probably made a mistake calling it a management fee because no one likes management fees, particularly institutional money managers who collect money. Well, they like management fees, but they don't like to be perceived by their clients of charging 2 layers of management fees. So I think I made a mistake calling it a management fee. But what we're trying to accomplish here is not to make some windfall off of a management fee. what we're trying to accomplish is to cover some of the costs associated with overseeing this entity. And this is not a case where Bill's working in a garage picking stocks for Howard Hughes. It's a case where we're trying to transform a business by making a series of acquisitions and overseeing private businesses, which is a time-consuming exercise. It's going to require a lot of organizational time to identify transactions, to do due diligence on transactions, to, ultimately execute and acquire companies, to, it's work. And Howard Hughes is going to represent a meaningful percentage of our assets. Today at whatever 16 billion of assets, this is adding another 10 billion of assets. So our assets, will be 40% of assets. With the management fee we proposed, it will be about 5% of our revenues. Why? Because we charge our other funds incentive fees, which are the bulk of our earnings, and we charge this 1.5% management here with only a management fee. We're not going to come close to recouping kind of the allocable share of costs. So it's not quite Warren Buffett working for $100,000, beginning in 1962. Although we got to future value that on with all the inflation we've had. It's probably 20 million today. But the 100,000 was a lot of money in 1962. I guess the point here is, we also can't. I think if we showed up and we had base salaries and bonuses and options, no one would sort of complain, because that's what they normally see. That's obviously impractical when you've got 40 people that you want to bring on in a company that's not of a scale that it can afford to hire us. And that's where we came up with the management fee construct. And, just a way to think about this order of magnitude. First of all, we're rebating to our investors any management fees on Howard Hughes stock that they own. So they're not, if you will, paying twice. We're not collecting any management fees on effectively the capital we're investing, because we're earning a fee on your own capital, isn't really generating any real revenue. So we're only ultimately netting 52 cents on the dollar of whatever fees we collect. So if the company today has a market cap of, whatever post-transaction at 4 billion or something like this, it will be about 60 million of management fee income, of which we get 30 million of it. We have basically 30 million shares post-transaction. So it's about $1 a share of incremental, fees to us. So that's a way to think about it, order of magnitude. So if the stock drops, $10 under our leadership, it's a disaster for us. And if it goes up $10, if management fee doesn't move the needle. So it's really about allocable share of cost. Now, we're sensitive to what we've heard about the management fee. We've told the board we're open to a different construct and how we're able to cover our, costs. And people have said, look, we'd like it to be more incentive based. We have some ideas there, but we need the board to come to us and sit down and engage on that topic. But, we're very, I would say, respectful and sensitive to this concern. We're not trying to make a lot of money here on a management fee. We're trying to build something of very significant long-term value. And by the way, we want it to be appealing. Now, by the way, the retail community have received actually handwritten, typewritten letters, many emails, tweets of support. And they're like, Bill, this is cheap. It's a bargain. It's a sideshow. I'm excited to be your investor. And so the retail community doesn't really seem to be particularly concerned. But yes, I've heard specifically from one institution who I spent an hour on the phone with yesterday, this was a primary concern of theirs. And so I think we can adjust this. Maybe it's some form of expense reimbursement plus some kind of incentive-based compensation. There's a way to resolve this. So it's not an issue that people focus on. But we need to engage with the company.
And let me just run a couple of suggestions, proposals, just to get your take on them. Like, one of the things I'm worried about is HHH stock flat over the next 10 years. It'll be sending Pershing, I think, about 700 million over that time. Would you be open to a clawback?
I think there are better ways to solve that problem. I get the problem. If we don't create value here, we shouldn't be collecting hundreds of millions of fees. But I think there's a better way to solve that problem than what you described.
To me, I have no problem Pershing Square profiting from this. I just want it to be in an equitable way. I really think you should do an Elon type of situation. Obviously, have better lawyers put it together.
That hasn't gone so well. The only people that so far have been awarded anything are like the lawyers of hundreds of millions of dollars.
Yeah, no. As I said, better drafting, but set huge targets. And if we win, you win, and vice versa. So I mean, but as you said, it's a sideshow. To me, it's price. You know, I think you made your bid at a somewhat opportune time, and interest rates were kind of.
Let me make the argument against that. Look at what the home builder stocks, real estate stocks have done since we made our bid for the company. And that collective group, last I checked, was down versus the $61 share price. And if you look at how Howard Hughes has traded over time, it's traded kind of in a range with that group. So the index is down. Okay, Howard Hughes is up. And the only reason Howard Hughes is up is because there's our proposal outstanding and people are expecting us to do something. So if we disappear tomorrow, I think the stock is at best in the low 60s. And at worst, it's in the 50s because people are like, if this strategic transaction fails, people are going to view our stake, rightly or wrongly, as an overhang on the stock. It's not a core position for us today. It's a small cap, relatively illiquid, large stake in a company that's not really consistent with our, if you look at the rest of the portfolio. So we're trying to make it into an investment. What do we do for a living at Pershing Square? We find companies that have either underperformed their potential, and there we come in and we help make changes to governance and in management, or we find companies that are or underappreciated by the market, and then we do this something similar. And that's what we're doing here. This is a company that we think has been underappreciated by the market as is, and we think with a change in strategy for the company, we can create a lot of value here, a lot more than can be created as a standalone MPC company. And I think, and much more rapidly, I think, could we attract a shareholder base that's excited to own it for the very long term. And there's been enormous turnover in the shareholder base over the last, really few weeks since our January 13th proposal to the company. I had a guy look today, 17 million shares have traded, right? That's a third of the float of the company, of the shares outstanding. When you take us out of the float, there are 31 million shares. Index funds own, I don't know, we should check what the number is, but even if you ignore the index funds, more than half, 55% of the stock of the float has traded in a month, right? Or 5 or 6 weeks. And I think the buyers, we had Jefferies looked at this, are people buying in under 1,000 share lots, which they would describe as kind of retail. And the sellers have been mostly dedicated real estate funds or people whose mandate does not include a diversified holding company. So the shareholder base of the company is changing pretty dramatically. I talked to one of the analysts who told me that nearly all of his clients had sold the stock. And this is sort of a dedicated real estate investor. I think the good news is the sellers, which are finite, the people principally who don't want to invest in a diversified holding company, or not because actually we got a lot of very nice complimentary words from this one asset manager we spoke to yesterday. But he said, look, I signed on for an MPC company, and this is going to become something else. And you guys have a great track record, but I signed on for an MPC company, which gets to your second part of your question, which is should there be a shareholder vote? So let's talk about that. So one, this is a transaction that does not require a shareholder vote. And the way the rules work is if you're going to do something really transformational to a business, the measure of that is sort of how much of the capital of the enterprise you're going to use to do that transformational. That is sort of like a hard line test. And so the rules say that if the company uses or sells in a transaction or a series of steps that are part of one transaction, 20% or more of its stock, then you need a shareholder vote for a transaction. This transaction, we're buying less than 20% of the stock of the company, so we're squarely in the space where we don't need a shareholder vote. So it sounds very democratic to have a shareholder vote, so why not have a shareholder vote? The answer is, number one, it takes time, it's expensive, and it increases litigation risk, interestingly. What people get sued for in transactions is what you say in the proxy. And when you put out 1,000-word, tens of thousands of word document, there's a whole industry of lawyers that look through that and they try to come up with something that will appeal to a judge. Oh, Your Honor, they didn't say this, they didn't say that. And it's just shareholders suing who owns 9 shares, just like the Tesla thing. It's not really a real shareholder often. Because why? Because the costs are absorbed by the company. So it's an overhang of the company. It can delay for months a shareholder meeting. And that's months present value basis. We're not putting capital to work, and it's legal fees and expense. So that's, I would say, the first point. The second point I would say is we own 38% of the company. Those shares are held by our clients, in effect, our investors in our funds. And we believe that this transaction is in the best interests of our shareholders. It's sort of our obligation to get this transaction done as promptly as possible. So we're going to vote those shares in the transaction. And, we're going to have support from, I hope, a large percentage of the shareholders. But the probability that we get a majority of the shares that show up at the meeting that vote in favor of us is approaches 100%. It's just the math when someone shows up at 38%. The typical quorum for a special meeting of this kind is 75 to 80% of the shares outstanding. So if someone owns 37.8%, on our vote alone, we're likely to get the transaction approved. So it's the vote, I would say, is performative, to use a word that has become very commonly. I never heard of the word performative, but in like the last, I don't know how many years, it's like every other day people call things performative. And the other point I would make, some people say, okay, well, you're conflicted on this deal, so we should just look to we just do a so-called majority of the minority vote, which you sometimes see in a going private transaction, because it can cleanse the affiliated nature of the transaction and reduce litigation risk. The problem here is when you have someone who owns 38% of a company, and you compound that problem by having a large turnover in the shareholder base to retail investors, and you consider the fact that retail investors, unfortunately, very rarely vote their shares. What it means is that, just again, the math, 50 million shares, we own 19, right? So there's 31 million shares that would be considered a majority of the minority. But typically, only 75 to 80% of the shares show up at a meeting. So in this case, that would mean 50 million shares, 10 to 12.5 million shares are not going to vote, right? So you take 31. Let's take the midpoint of the range, 11 and a quarter. So 31 million shares, you subtract 11 and a quarter. There are only 20 million shares that are going to vote to determine the outcome here, which means that 10 million shares plus one is a majority. And if you look at the shareholder registry, ignore us, the top three shareholders own 10 million shares. So three shareholders who own less than 20% of the stock of the overall company will be deciding on behalf of all of the shareholders. And to me, that is vastly less democratic than letting all the shareholders vote. And why should my shareholders, my investors, be deprived of their vote in the deal? So I think it sounds nice in practice. It sounds democratic in practice, but I think it will turn into, it creates litigation risk, takes time. And if we took the majority of the minority approach, you're handing control to people who own less than 20% of the company, which I think is not good governance.
So you'll end up owning 48%. I think I'm a big fan of the outsiders. I think having big buybacks, I know wouldn't be your first use of capital, but over time it could be extremely effective. But if you do a big buyback, then you're over 50. Like, what kind of protections do shareholders have on that?
So number one, we said that this will be an independent board that will govern the company. And by the way, when you own 48%, or even if you own 38%, you can have effective control of the company. So Howard Hughes is not, it's a company with very large major shareholder. And whether we own 38 or 48% or even 52%, I don't know that it matters that much. We're an important voice. So we would contractually agree for the company to have an independent board. We agree, we believe in good governance. We believe in independent boards of directors. And, as we said in our proposal, we'd commit to keep that, all the relevant committees would be controlled by independent directors. And, while we'd have the right to run the company without these protections, because controlled companies, don't have to have these protections under the exchange rules, we would agree to them.
In some sense, HH8 seemed like the wrong vehicle to do this. Public markets, don't do a good job of valuing real estate, as you have seen over the last decade or so. Have you thought of perhaps doing this with like an insurance company? Markel, the name we own, seems pretty cheap and generates a ton of cash and easy for investors to understand. Is that something that you considered?
So we haven't considered acquiring another insurance company, but we've absolutely considered, and in fact, have likely identified a leader who, our plan would be to recruit into Howard Hughes, behind which we would build an insurance operation. And we do think that could be, there's a reason why Buffett has used insurance to generate low cost float and as an investment vehicle. And that's certainly in the cards for this company.
So what type of insurance, do you do?
Because we haven't yet made a deal with this particular individual, and it's a known individual, I'd rather not narrow the case even further to talk about what kind of insurance we'd likely pursue. But it is something that we're seriously considering.
No, I look forward to hearing more about it. And, I think the bottom line, obviously, we can disagree, or it seems like you're open to negotiation for a different type of incentive structure, but the sideshow. To me, at the end of the day, I don't think they would be thrilled. I think minority shareholders, though, if you did something in the low hundreds, if you knew for certain it would go through and you could just have some sort of carry based on how the stock does for a long period of time, but would that be something you'd consider?
I think we should save the negotiation for us and the board and the special committee.
I had to try.
Okay. As I said, we're open to having a discussion. I do think, we're paying an extraordinary price to not buy control of the company. Our influence in the company is not changing materially if you go from 38 to 48%. Tomorrow we could run a proxy contest, and we've replaced boards of directors. Canadian Pacific, we had 12% of the stock, replacing the entire board and put in our candidate. So going from 38 to 48 is not a change of control transaction here. And I think we're buying stock at a big premium. I think that's accretive to the current shareholders. I think it sends a very powerful message that we think we can create value beginning 46% above where the stock was before we proposed a transaction. And the other thing that you should think about on behalf of the shareholders here is what happens if tomorrow, let's say the board was intransigent or whatever, we couldn't do this deal, and we just, where does the stock trade? It's not going to trade in a good place. And the world is going to say, okay, Pershing, tried everything. Okay. The company tried to sell itself in 2019. Pershing tried to take it private in, the fall of last year. And now Pershing proposed a relatively straightforward deal where they would simply invest capital in the company. It didn't require a shareholder vote. They were putting up $900 million in capital. They were open to negotiating, making their, cost reimbursement charge, more incentive based. And that didn't get done either. Where's the stock going to trade? It's going to trade into the 60s for sure. And it could trade lower.
Why is the stock trading at 75 if you're willing to put money in at 90? What's the market telling us?
It's hard to determine that with specificity, but I'll give you some insights. Number one, the sellers are people who don't want to invest in a diversified holding company because it's not their mandate, or they're nervous about their clients not liking 2 layers of management fees, and they're not hopeful that gets resolved in some other way. The buyers, I would say, are retail. Who want to bet with Pershing Square and like the idea of a modern day Berkshire Hathaway. That's, I would say, the buy-sell universe. And then the sideline people, which is I think a very significant base of demand, are institutions that want to invest alongside Pershing Square. And by the way, we know many institutions. The nature of our business is we've been managing money for sovereign wealth funds and family offices, and people invest in hedge funds, et cetera, for a very long time. But these are investors that don't take what I would describe as, risk arbitrage risk. And the risk arbitrage risk here is real, right? What the stock is telling you is if this deal doesn't happen and the stock goes into the 60s, right? That's somewhere in the expected value of 73. And actually, the more time that goes by without a deal happening, the more people are going to be, nervous about that. In fact, the stock was, it traded to as high as in the mid 80s. We first announced the deal, and when a lot of time went by without an announcement, the stock was as low as 71. If we filed our 13D, got as high as 86. But when people got concerned the deal might not happen, it was 71 at the beginning of the year when we announced our first, proposal to the company. So I think the more time that goes by without a transaction announced, the more people think, okay, there isn't a deal here, and it's heading back into the 60s because the group has traded. The group of which this is a part, there's no perfect comparable, has traded lower. And this, at a minimum, is going to go back to, and then the offset to that are people who think the transaction is going to happen, right? But until a deal is done, we're not going to really see where the stock's going to trade.
Listen, I'd love for a deal to happen. It's obviously one of terms that our shareholders and my research clients, expect. And I get what you're trying to do, and hopefully they can come to some sort of resolution.
Excellent. Well, hopefully this long form conversation will inform them in a way that gets us there. And we look forward to the opportunity to sit down with a special committee and the board and get this done.